This is Tim, Raja, and Peter, and Tim will lead the panel and introduce the panelists.
Sure. So, by the way, I have my notes on my phone, so I'm not trying to be rude. I'm not like tweeting, although I could if you want me to. Yeah. So again, you guys just heard from Peter and Raja. He's an advisor with me over at a company called R3 in New York, and has a long background in finance. Would you like to briefly describe what you?
Sure. So I've got a background in foreign exchange trading and capital markets trading, and I've worked at places like Bank of America, Citi, Wells Fargo, Silicon Valley Bank, and throughout my career, started out trading, and then ultimately got involved in technology. In the '90s, I had 2 startups. One did pretty well, the other one didn't do well. So I got both sides of the burner on that one. And then I ran a number of electronic trading products at Citi, as well as Silicon Valley Bank and Wells Fargo as well. And so about 2 years ago, 2-3 years ago, I started my own sort of advisory, and it, started to look into blockchain. It was hilarious. My partner, when I first got wind of, Bitcoin, and I told him, I said, look, we got to pay attention to this. And he told me to fuck off. And that's the typical response you get from traders. And so over time, he is now deeply involved, and in fact is an advisor in his company. And so, it's Phil. And so, so I guess the thing is, through that evolution, we've learned not only about Bitcoin, but the underlying technology and what are the uses within the financial, the capital market side of thing and banking. So that's kind of what I'm doing with Tim, with this entity in New York, where we're evaluating how to implement blockchain technologies within the capital markets.
Great. So actually, I want to start with the first question. My new friend at Coinbase back there was mentioning, he's like, is all this just free hype, just like merchant activity was last year? A lot of companies saying we accept Bitcoin. Are companies in financial institutions that say, that, oh, we're looking into a blockchain or the blockchain or ledgers or whatever, is this all just a PR stunt? What do you guys think? Is there some actual meat to this?
There's definitely meat to it. I think it comes from probably like 3 levels, in my opinion. Number one, you have to look at the financial institutions and segment them so that you can understand what purpose they're trying to solve. So number one, looking at payments. Payments are a very big space. If you look at the structure of the market, you've got correspondent banks, you've got third parties like the Visas of the world, interchange networks, you've got SWIFT, you've got all these things that are a big jumble. And so from that perspective, where the bank stands ultimately is that, they ultimately make money on these transactions and they own that piece of it. So on the consumer side, they'll have one component of revenue flow. On the wire side, more like the institutional, as you go through, that's why you get charged $35 for a wire. So when you look at that, you look at how Ripple is taking advantage of that particular segment of the market. The way they've gone about it, I think, is actually clever. They're going inside the bank to look at intercompany transfers. So that's a good use case for starting out of the gate. So that's one part of it. The capital markets, on the other hand, there's a trade life cycle, right? So there's an issuance of a security and everything that goes along with that. There is the actual pre-trade issues that go forth, from KYC to credit management to margin acquisition and so on. There's a whole series of things that have to go on. Then there is the actual execution and the settlement, custody, and ultimately the settlement piece of it, the clearing. So you have to look at that in its totality to see how does consensus networks actually fit within that context. The work that we're doing, we've got a number of banks that we've effectively looked at the entire trade life cycle and have gotten probably about 100 some odd use cases with our specific elements within that. And so I think I've heard a lot of questions about what are banks actually interested in? Well, they're interested in a lot more than you can imagine. They have labs that are already, that have already ferreted out, what does a smart bond contract look like? You look at derivatives, you look at interest rate swaps, you're looking at equity, you're looking at all these different things and modeling it within the context of so-called smart contract, and they're finding deficiencies, and so they're learning. So from our perspective, we provide that kind of knowledge back and forth. So the third part of the banking side of things is kind of the commercial bank side, which is trade finance, lending, very traditional consumer deposits. So all that taken together, there are multiple ways in which each of these can go. The biggest issue is I don't think there's really a notion, like you can't disrupt it. I think, disruption in my mind is two things, right? It's a displacement of the zero-sum game of the existing players, or you've actually created like a blue ocean. Great book back in the 90s. So the best example is like Southwest Airlines took away the 300-mile car market, right? So they priced it for 49 bucks, cheaper than filling up your tank and going, from Dallas to Houston. So from that perspective, those kind of things the potential is there, but I haven't seen it yet. I haven't seen any entity that has come in and said that this is where it's going to go. It's very difficult to do. So each of these companies have to ultimately face banks because they own the last mile when it comes to the infrastructure around payments, capital market structure, and so on. So anyway, long answer to your question is, yeah, you'd be stunned at how deep banks are actually evaluating this.
Peter, any other thoughts on that?
I think Roger did a really good job. I think the only thing I'd add is that there's a convergence between the financial services side and the Bitcoin or blockchain technology side. There's a growing understanding of both sides. I've learned a ton about how complicated financial services are and what it takes to deliver those services to consumers and to corporates. And so that's an opportunity, which is what's attracting blockchain companies, is that there's actual real value that can be delivered here. And the financial institutions are seeing the same thing. Like, I can cut out huge costs and inefficiencies in my organization with this technology. So I think over the last year and a half, there's been this convergence of understanding between the two sides.
Okay, well, let's talk about a specific one then. Let's talk about FX. I know that's something we've, as an organization, or with R3, we've looked at FX settlement fees. What parts do you think of the whole trade life cycle, what could be potentially benefit from using a distributed ledger from what you guys have seen?
So we've tested out, a proof of concept where we've taken what's called non-CLS currency, and for those that are not familiar with CLS, just to take on what Tim had said before, it's a utility within the trading space where the central banks are mandated to have accounts with CLS. So that's how you create settlement finality. So they've got like 17 currencies or central banks in which they have. So the dealer community is able to go ahead and do spot trades against it, and so CLS will actually settle those trades so that you get a washing of the account. So what it does for banks is they don't have to have correspondent banks for each settlement account, so Polish, Hungarian, whatever it might be. So CLS, performs that function for spot contracts. Now, we looked at it and said, all right, let's take a non-CLS pair, so Polish or Hungarian against, say, the dollar, to see actually how blockchain technology could be utilized. So at a very basic level, you can run the trade life cycle, which is, okay, I got accounts, I got counterparties, I can trade, I can post it to the blockchain, and then I have accounts that get so-called settled. The reality is that you'll have effectively a display of the balances, on a netted basis. And so in that sense, we've been able to showcase how a very, very mundane, simple FX transaction would occur. The reality is you've got to figure out settlement finality in order to be able to go ahead and run the full loop of things. So from that perspective, I think FX, its entry point for new entrants in the space, I think come from, like I said, I think what Ripple's trying to do in terms of looking at it like internal cross-border transfers. I think that once with all the digital wallets that are out there, the notion of converting currencies, it's going to have to, Bitcoin or whatever, is a free transfer, or Coinbase charges 1% or whatever they do. But, in that sense, that's a long-term play because in the end, you're still going to face the same problem. Each central bank has actually specific governmental rules on finality. So that means you're going to have to effectively manage all of that process. So I think that in the pure cross-currency border play for consumers and businesses, I think that's a tough road. Just because of what was said. I think that, in terms of if there is a way in which you'll get settlement finality, as part of it, I think, in the end, then currencies are wide open, because in that sense, you have a lot of people there's so many little companies that play in the currency exchange space, money transfer businesses and so on. But, and so then there's of course like, Western Union and so on. And so they just kind of own that space. So it might feel like it's easy and the numbers are really big, but just to give you an example of like numbers. So there's a little company that I just talked to, yesterday, and unfortunately I gave them the news that they're going to be dead in less than a year. They claim that they're going to be forecasting about $3 billion in annual turnover, right, for currency. Sounds big. It's ridiculous. They'll make about $280,000 on that, and they just raised $22 million. They will not survive. On the other hand, there's another entity in the institutional space that turns over $35 billion a day. That's typical of like venues that execute in the foreign exchange area. They're going to make roughly around $10 million in just that one product. And so their overall, revenue structure for other aspects of it will run about 30 to 40 million, and they're probably going to be sold for about 400 million relatively soon. So it's volume. You've got to be able to handle volume.
Sure. Have you seen the same thing, Peter?
Yeah, I mean, I think again there is what's interesting about the CLS versus non-CLS is that there are these opportunities to play alongside with the existing infrastructure. So there's a pain point for non-commonly traded currency pairs. So I think that's what a lot of institutions, financial institutions, are looking at is like what are the adjacencies where there's a lot of expense and time and people being utilized to handle these use cases. Foreign exchange is one of those cases where like you want to deal with Polish zlotys, it's kind of a pain. So why not just find create another utility like CLS that deals with all of these others? And then why doesn't CLS just do this? It's because there's a cost structure to it that they have today. But with this new blockchain technology, there's an opportunity to create a much more efficient cost structure for lower volume transactions like that. So I think that's what financial institutions are looking at, is seeing, well, what are the things that I wish I had, but I can't afford to do it today? And those are those open spaces that we're looking at.
Yeah, you both raised an interesting point. There's a website, if you guys are interested, called saveonsend.com. It's run by Yakov Kaufner in New York. And basically what he does is he looks at the international payments, cross-border payments, remittance space. And he spent a lot of time. Actually, I met him because he wrote some articles on Bitcoin. Obviously, he was trying to kill it too, just like I do. No, it's a joke. But yeah, he mentioned the same thing. Like when you see people at conferences saying, "Oh, these you have 20% markups on remittance," and they're just milking the consumer. Well, really, it's just a couple corridors of that, and there are these like really low volume, low transaction corridors that are fairly high risky in like Africa and emerging markets. I'm not defending status quo, but at the end of the day, some of those markets aren't quite the cookie cutter Reddit cartoon that people like to make it out to be.
What's the website again?
SaveOnSend.com.
Save.
SAVE. Save on Send. Yeah. He just recently did one on Western Union explaining what their cost structure is and how they're so dominant and stuff like that. Like if we're going to measure success based on like whether or not stocks are doing good, which is one indication of whether or not a company is healthy, Western Union's not dying. And I'm not defending how they are operating, but it's not. You can't just say, oh, blockchain or Bitcoin and everything's magical. You have to actually look at what the actual cost structure are. And for many of these companies, it's going to be a compliance race, or you need to be compliant. It's an execution race. Can you execute against all these other remittance companies? I mean, remittance is typically started. Remittance is a portmanteau of remittance plus Bitcoin, and it's usually companies that were exchanges and just couldn't see the volumes, and now they're looking at doing this other stuff. So that's a whole other topic. I don't want to distract.
But maybe to add on top of that, I mean, it doesn't have to be necessarily an external company using this technology to disrupt someone like Western Union. We've had discussions with a Middle East bank that wants to create their own remittance corridor to Asia because they have a lot of bank accounts from foreign workers, and they send the majority of that money home to places like Malaysia, Philippines, Indonesia. And so they're like trying to find ways to add value to the customers that they have, but keep their costs low. So their idea was, well, why don't we create a relationship with a bank in Asia, create a private blockchain between those two institutions, and they'll just keep track of the ledgers between the two of them, and then they'll settle once a week on the actual money. And so they've created a very low cost remittance corridor for a certain segment of their market. They're able to probably gain a lot of more customers, gain loyalty because they're competing with Western Union and being able to send these funds home for a lot less money. They get to do things like preferential foreign exchange rates. They get to do all these different things because of this private blockchain that they've created with another institution. And you can imagine them probably adding more institutions to this private network as they want to expand their footprint. So it doesn't have to be an external blockchain or Bitcoin company. It could be just another institution killing another institution too.
One of the conversations, or a couple of questions people have mentioned so far today, was talking about, what part of what efficiencies can be gained from strictly changing business processes versus what the tech is itself. I think the example that I've heard, not just here but elsewhere, is with syndicated loans. DAs come out and said, "Oh, we want to do that somewhere," and I've heard a couple other companies. But when you look at it, the syndicated loan, if it's settlement times T plus 27 or something like that, 24 or 25 of those days involve like legal issues like signing paperwork, and only 2 or 3 actually involve tech itself. Like, how much is desirable in terms of these different use cases you've seen are for actually reducing the actual like legal overhead versus the tech? Like, is there an actual play, or is this just kind of just a bunch of vapor at this point?
Well, I wouldn't call it vapor, but the potential for shrinking the time cycle and equating that to cost reduction is definitely there. The issue is what cost, in a certain respect, right? Because settlement in and of itself is a trivial matter, because if you know the counterparties, or at least the availability of capital and you exchange it is there, that in that sense it can be done very, very quickly. Like foreign exchange, for example, you can do same-day settlement in Europe, or Mexico in this country, and so in that sense, I think the real trick is going to come down to looking at each part of the trade life cycle and understanding how your existing operational support structure is and cost structure in that, and looking at the databases that you have, your tech infrastructure and all of it, and go, well, a consensus network and a distributed replicated ledger effectively collapse that into a singular event, which then strips out all the costs. To give an analogy, right? I mean, what I found unbelievably disruptive is basically online banking. So there was a study done a couple of years ago where the cost per transaction for a branch teller was in the $3 to $4 range. It's now about $1.60. The cost for a call center is $4.28. The cost for online banking is 9 cents. The cost for mobile payments is 19 cents. Well, guess what? There's 93,000 branches in the country today. It's going to shrink down to about 70,000. That's real disruption, right? Because you're looking at it truly from a business case. So the banks, when they do this, they're going to be looking at it very, very similarly. So in terms of all the people that we speak to, the business units, heads, are looking for that 20x reduction because they want to get rid of a bunch of people. I hate to say it that way, but that's true.
Are you anti-people? Is that what you're
No, not at all. I think that, I think there's innovation as a result of that. I mean, the banking industry went through a very heavy consolidation, after the stock market crash in '87. Effectively, a third of all bankers got laid off. Well, they've ended up in different spots, so there's human pain. So, it's not like I'm advocating for that. The inevitability of tech automation will happen. So the issue is, how do you manage the adoption process through that? So to answer your question in short, yes, there's definitely lots of different paces, but the problem is it's so complicated. So in each of the segments of the trade life cycle, there are just millions of issues. So, in a way, the hard part is most technology solutions are single bullet, right? They take care of like a specific thing on issuance, for example, or if it's a settlement issue or an execution venue, it does certain things. But you have to actually gain collaboration. And so in order to do that, you're exposing things like balance information, clearing information, and so on, that competitors in the space don't necessarily want to have. But I think technology will solve it, and I do think there's real opportunity.
It's not thinking of the legacy system the banks have, right? They have lots of legacy systems sitting around interacting with each other, right? Yeah, you put it into block a permission ledger, but they have to interact with other systems within the banks, right? The risk management, the other stuff, right? Which they still have to use anyways. So do you guys also think there's an upfront cost initially, right? Which are
So
Can
the
you summarize?
so the question you're asking is, does a new rail need to be built, or do you integrate into the existing environment?
Right.
And what do you do about the sunk
What
cost of
about
that?
the, peripheral systems?
Like, in my mind, there would be absolutely no reason to deploy any of these technologies if you had to integrate into existing systems. New rails have to be built. And that's going to cause a great deal of grief, right? I mean, that's going to cause adoption problems. You know, for example, like Citibank, they have a $9 billion operating budget for their technology group. That's bigger than most technology companies on the planet, right? And it's a very dysfunctional group because they've had to merge, 7 banks effectively and an insurance company and everything else. So those systems generally don't talk to each other. So there's no way that you can intercede in the middle of that with this kind of consensus outside of looking at it from a perspective of Citi is its own ecosystem. So for example, they've got one instance, they've looked at a use case where they look at client trades coming out of London being executed on behalf of for a US stock out of here, and it's called Rule 153. And so the issue is they have thousands of ledgers that manage that process. It's very inefficient, it's extremely expensive, and so from that perspective, if you look at internal consensus, which is why I think things like a permission-based ledger would make sense in that instance, is because the players, you need high throughput, you can stick it within your own, have a rail, you code against it, and guess what? You may have solved that problem, and then over time you can migrate it off of your legacy infrastructure. So banks are looking at it from that perspective.
So disruption happens in 2 forms. Obviously, there's disintermediation where something in the middle can be taken out and removed. But disruption can also happen when something that people thought was one function can now be separated. Do you see any of those things, opportunities in that space?
Let me see if I understand your question. So you're saying once it's implemented, it's the aha moment we can do these other things as well?
Yeah.
Yeah, I think that without a doubt, I think inevitably that kind of discovery happens with all technologies. So like Tang, for example, in the '60s, right, was just a function of some chemicals that you sent with astronauts, and the next thing it's on the grocery shelf. So absolutely, I think what happens is you can only model and picture so much, right? Once it's in the ground, then you're going to know what you can actually add to it. So there's going to be a huge iteration of things that the banks will try to innovate on, because once they see some benefit, a significant material cost benefit or operational benefit or whatever it might be, they these are creatures of habit. They'll kill it. They'll do it again and again and again and again. So yeah, I definitely agree with that.
I think it's the first time I've ever heard Tang used in a blockchain panel, but
Well, I'm dating myself. So.
What is Tang again?
I'll get you a bottle.
but I think to what Raja was saying, that we're in the early stages of this technology cycle, and oftentimes our frameworks of thinking is based upon what we know today. So like the car was the horseless carriage, and so I think that's the stage that we're in right now. So we're sort of using the frameworks that we understand, like clearing and settlement and payment and remittances, as the framework because we get that, and this is like that. I think in probably the next year or two, we will evolve that framework, that line of thinking, so that we can go and start to pivot. Well, we use it like this, but we can also use it like this. We can also use it like this, just like the internet sort of evolved in the same way.
Did you have a question?
Yeah. Do you think the primary benefit right now of the commission ledger is the fact that it fits within existing regulation for banks? Do you think from the end user perspective, is there really any benefit, or is the primary benefit just the fact that it does fit within the bank's existing regulation? It's kind of a broad question, but I'm just curious if you guys have thoughts.
I think
Repeating the question, please.
so. The thing is the primary benefit of a permission ledger is that it fits within the existing bank regulatory structure. And I think I would just change the question. It's what does the consumer want? I don't think the consumer will really care whether it's based on Bitcoin or a permission ledger or on mice. But what they want their money to act like email, right? They want it to be fast and cheap, and have it just work. And so I think right now what we're seeing with permission ledgers for financial services institutions that it does work with that structure, and it gets closer to what consumers want. With Bitcoin, there's friction there. I mean, it does do a lot of the things that the consumers want, but then there's a lot of work that the consumer has to do as well. So I think that there's an opportunity for a financial institution to get closer to what people want to have their money behave with this infrastructure. And if it works, then that's all the user.
I would, to answer your question, again, I go back to, you've got to segment out what part of the financial institution business you're talking about. If it's a depository commercial bank, that's one aspect of whether permissionless ledgers and so on would make sense or not. Because that's going to take some long time to unfold, because there's great opportunity, right? If you take some modern banks, I mean, what's for them to not, come up with a completely new notion of what a wallet is and the value of the exchange of that, right? It should be part of, it's monetary. It's also part of your, loyalty reward points, savings on whatever, right? You can package all of that, and then you have a new kind of form of value. So that's down the road. So that's one part of it. Does that become a permissionless ledger base, right? Because you want to ensure that you've got security around all of it, you want verification and so on. If you're talking capital markets, the difference there is, yes, it's highly regulated. But part of the reason why I think most of the banks that we talk to fundamentally have concluded that we're going to go with a permission-based ledger, it has so much to do with counterparties. If they get comfortable with the notion that I don't need to know my counterparty, which they do, they've got dark pools in which you trade. You don't know who it is while you trade, and until you do your settlement. So it's funny and almost a little ironic they're not able to, abstractly think that way and say, well, this is a way for us to, employ, all the wonderful benefits of the Bitcoin technology network. Instead, the thinking is around, we're regulated, I want to know my counterparty, I am going to exchange some very proprietary and sensitive information. I don't want any of that to go out of our domain. So I do think that in the long run, I think there'll be these domains, right? There'll be a permissionless ledger for, some aspects of maybe KYC and validation and verification of the pre-trade side of things, whereas the actual transaction base will all run through these permission networks, so they can maintain the integrity of that piece of it. So that's capital markets, right? And then you've got insurance and you've got other elements of the buy side, and then of institutional trading that you're going to have to think through. Then, so that's why I was saying I think that there's a lot. There will definitely not be a one size fits all, and I think it will take time. You'll see it evolve. I mean, we're really at the very beginnings of that decision making.
Do you think the incumbents can really win with Bitcoin, given that it's a disruptive technology? Take Western Union. How would Western Union compete against international remittances on the blockchain?
Well,
I could answer that easily.
The question is?
The answer is how can Western Union compete with Bitcoin? If you look at what cost structure for Western Union is actually, it's the two largest things are the physical network, the agents on the ground, so they have 500,000 facilities globally, and the other is compliance. If you build a company based on a remittance product, a Bitcoin-related product, and you try and scale it, you're going to attract attention from compliance officers. So eventually you're going to absorb the same cost of compliance. And then you're going to run into the same issues with both liquidity. I did some work with an exchange in China for a while, and we looked at a lot of these Southeast Asia exchanges and stuff like that. One in Vietnam, the biggest one, did 5 Bitcoins a day in volume. You would just crush the market if you try to do any amount of volume through there. So what ends up happening is everyone just trades off-chain through trusted parties. If you're doing that, there's no reason to adopt the marginal cost of a permissionless ledger. I'm not saying that there won't be some margins pushed around, but again, I don't think that you necessarily need to use. I don't think Western Union has anything to fear from Bitcoin-related companies at this point. Maybe somebody like Abra does do some interesting things, but that's peer-to-peer mugging. I think eventually, if you scale that, who's familiar with Abra? Anyone know Abra? So Abra, they're calling themselves Uber for cash. Well, we already have it. It's called local Bitcoins, basically. But you're basically a red dot on on somebody's phone, and we know that person has a lot of cash. So for 1%, is it risky enough for you to know that you could be mugged? I don't know. Obviously, that's a different issue. But they're gonna, if they scale and become successful, they're gonna need to get a bank charter, I think, or MSB or something like that. And if they have to absorb the same cost structure, then what is their actual competitive edge against Western Union?
thing I like about their model is that they bring competition to like a marketplace that has not seen competition before, right?
When you say who's they, like Opera?
Yeah. I mean, the fundamental advantage Western Union has is they essentially have a monopoly on international money transfer, right? They have
They've had 15% market share.
but they have, I mean, their advantage is they have these operators that cost a ton of money to set up, and there's not competition in a lot of different remittance markets.
Well, the reason they're not in, like, for example, Africa is because it's just not popular for you and I to hang out in Africa. Like, there's 80, in Manila alone, there's 80 money transmitter operators. There's plenty of competition. It's very, the margins are very, very low. Like, I'm not defending Western Union, but I'm saying, like, it's not this cookie cutter cartoon that we've imagined. You see $550 billion of remittance, and the average is like 9% fee. Well, the reason you have these fees is a lot of that comes from like African and emerging markets that nobody really cares about anyways, and there's no Bitcoin really.
The high fees, there's high fees because there's not competition, right?
Well, it's 'cause
That's the fundamental reason.
Well, there's also compliance costs and risks because those are risky countries.
Right, but a model like Abra where you're storing Bitcoin locally on a mobile wallet, their plan is that there's not going to be regulation.
Well, I know that's what their assumption is. It's not to be
Well, I
regulation.
mean, that's the U.S. defense and guidance has been if you're not storing private keys locally or hosted but locally, then you don't have to be registered as an MSB. So they do have.
We literally have a whole long conversation about if you become successful and there's lots of people coming out of your door because you're an Abra person, I guarantee you that you're going to have to deal with taxes or regulation in that country. Like, ignoring that, I think is naive. That's
Yeah,
my opinion.
I agree with that, but the fact is that now anyone can do that with a mobile phone, right? And there may be some, they're going to have to deal with taxes, but it's still something that's not possible for you. So I think I mean, again, there's a lot of, it's a start, right? There's a lot of holes you can poke, but there's also a lot of promise, so.
Do you have more questions for you?
How about this? Are the questions related to what we're talking about right now? Because if you can't, we can hold it until after. Is that okay?
Maybe he's got a couple more questions for his panel.
Yeah,
We'll take a few questions at the end. If
Yeah, I'm
that's
sorry.
okay.
Can you just write it down real
Yeah.
quick? So I did have one more question for you guys before we get onslaught by these guys. The last question I had was related to identity and data protection. So I know we've talked about this with R3 is the identity piece in terms of how do you handle KYC in a decentralized or distributed manner. What are your guys' thoughts? How is this actually going to be taking place? You see startups identify with an I believe, is looking at it. You had Patrick Egan who's looked at it. You have a number of people making proposals. What do you guys think can it be done? Should it be done? What are the costs of this, et cetera?
Yeah, this is a little out of my depth. I think, I'll take it from maybe a different perspective, right? It seems that identity management in the capital market space are going to converge upon existing taxonomy around how to identify an entity, person, whatever it might be. So with Dodd-Frank a couple of years ago, they forced legal entity identifiers. And so from that perspective, that's the easiest thing to basically say, okay, at least we can merge around that concept, because there is already a process where a couple 100,000 entities have been placed with an identifier. It's been mandated. And so from that perspective, the flaws in that model, there's no updating. Right now it's in a very large database. It is used for capital markets trades on derivatives trades. So it's a slice of life, so to speak. So in terms of identity, I look at that and I go, all right, maybe in terms of, identity may be forced to adopt something like that. I'm not saying it's good or bad. It's just that I think the banks are going to be looking for models that they can rely on, and it is somewhat recognizable. I think the better opportunity ultimately is to create an entirely new rail or new model around that. So from that perspective, I don't know all the details around that. I mean, it's a very difficult thing. I think, since LEI has come into existence, there's always an identifier. I think the hard part is just validating who they are at all times, and making sure you can track the life cycle of the identity so that it fits whatever set of rules that you're going to be engaged in, whether it's trading, whether it's KYC, whether it's account validation, whether someone died, whether you've changed corporations, whatever, right? So from that perspective, it's all. So that's entities. I mean, as far as individuals, I mean, it's even more complicated, I think, because, I mean, you know, you already have many identifiers, your driver's license, social security, whatever it might be, so what are you going to use? So I don't know, this is a confusing topic. I think in the end, because it's complicated, I don't know that anyone's going to have some kind of universal, you know, identifier. There's probably multiple versions of that coming through. So it's important, I just don't know what it is. Peter might have a better sense of that.
No, I mean, I agree. That's one of the reasons why we're focused on these private, isolated chains with known counterparties, is because it sort of skirts that issue of identity, right? So if we were talking about institutions, there are already identifiers. And then even if you're going at the individual level in an institution, they have to identify themselves. So there's a clearer path with regard to identity in a private isolated chain. And something that's more public or more permissionless, I think there's still challenges. I think it's just again verification. Your different ways of identifying yourself, but how do you know that the thing that you're using to say who you are is true? And so that's that connection between the digital and the real world is still unknown. I think it'll get solved, but I don't think we have a clear path to that.
Christopher, you have a question?
Yeah, so, I mean, Vitalik says Ethereum has a 50% chance of success. He's going really out there with smart contracts. On the other hand, the smart contracts that are in the 7 standard transactions in Bitcoin, very limited. Where is the sweet spot? I mean, there's something between the total flexibility of what Ethereum is trying to do. On one hand, it allows all kinds of sophisticated options, and then there's what Bitcoin can offer, which is deliberately limited and such. Is there, where do you feel like the first fintech smart contract stuff will happen as opposed to experimental?
So
So he was wondering, we have nominal Bitcoin systems, and then you have other systems using proof-of-work blockchains like Ethereum that are allowing for a Turing-complete smart scripting language that allows smart contracts that are not hand-coded, because you need to hand-code it for Bitcoin. So he's wondering, is there a spectrum? Is it binary? Like where is there a sweet spot? Is that what you were saying?
Yeah.
So, yeah, it's a big question, right? I mean, so maybe from our experience, the smart contract abstraction seems to align itself with existing things. So in this instance, like take a bond or an equity or whatever, like an asset. So from that perspective, people are looking at it, because the smart contract in my mind is still a little bit of a nebulous concept because it has so much to do with the potential of automation, that I think it dilutes the value of what this thing really could be. So the initial phase of this is to look at it and just go, okay, let's do an interest rate swap. Let's do a convertible bond. Let's do an equity and then call, a future dividend placement back to the shareholders, right? So the way that I think that we've examined it is to look at it in its really plain vanilla instance. Like, what does a smart contract model against an existing asset class? What are the implications of that? What happens on issuance? What happens to the legal terms on settlement? What goes on about future payments, time-based payments? Like, how does the blockchain technologies handle that, and so on, right? So that examination is definitely going on right now. So in that sense, to answer your question, I think there's all these potentials for so-called smart contracts. I think right now, the experience that I've had with banks is really trying to isolate what's the automation value and how complicated can that really be, and how can you extend it to replicate what exists today in the market, where that process isn't singular. So you pay coupon interest on a bond if it comes from the Treasury, right? There's custody accounts, there's the origination person, there's multiple parties that are involved. So the idea is to flatten it, and so maybe smart contracts will do that. Maybe some version of the Oracle will do that, and so on. So I think there's lots of potential, but the way I've seen it today, that's kind of how things are being tested.
Yeah, I would do a little pitch then for Blockstack, is that it does sort of sit in that middle space between Ethereum, which is trying to do everything within its scripting language, and the limitations of Bitcoin. So if you can wrap Bitcoin with a construct to manage these transaction flows are modular. So it's not the inside the scripting, but you sort of wrap something around it to enable these transactions. I think you're getting closer to what financial institutions do.
All right.
If you haven't asked a question yet, maybe we'll get some people who haven't asked a question yet.
We just don't like you. That's the problem.
I guess the question I have is, so we got a lot of POCs out there, right? But we haven't seen anybody necessarily take the plunge and say we're going to put it into a production system and scale it. So there's a lot of reasons for that. I guess I'd be interested in your perspectives as to, what you guys see as, what do either the startups or the incumbents need to do, or maybe it's the regulators, some other stakeholder, to really help take, these POCs and put them into, some sort of a production environment.
So there's a couple of things, right? I mean, it kind of depends who you're talking about, right? I mean, Ripple will tell you they're in a production environment now, so that's probably the closest live example of a consensus, right? So
I'd say at scale.
At scale. So yeah. So if you're looking down the future, there's probably, I would imagine that, like right now, the banks probably have three very, very big considerations, right? They can join a member group like DAH, where they've got a closed loop environment for settlement and so on, right? Or the banks can do it themselves. And so if they do it themselves, there's a technology infrastructure analysis that has to go on, kind of to your point, which is, what's the switching cost and how painful is that? The second part of it is the regulatory constraints. That's why you look at it the trade life cycle, because you have to look at each asset class to see if there's a fit for this flattening of the process, right? So that examination takes time, because that's a very, very complicated thing within it. And the last part is, budgetary in a certain way, which, well, I take that back. Risk management is a real big deal. Production systems at financial institutions have to be bulletproof. There's too much at stake. And there's so much fear, despite all that you'll hear about Bitcoin and security, nobody wants to take that risk, because it breaks once, you're screwed. Because the regulators will be on you, the public will be on you, your shareholders, everything. So the risk management part of it is what the business unit that's very enthusiastic about implementing has to go to their, to the CEO committee, ultimately, to ensure that this thing will not break. Because to give you an example, right, the cost of breakage. And you asked a little bit about trade breakage before. When I was at Citi, we had a bizarre outage in the switching of a router. And so what happened was trading was out for foreign exchange for about 4 to 6 hours. We lost about $18 million that day. That's a lot of money. Now that's just one small instance of how things work out. It turned out that there was a bad wire and the thing burnt out, and so no one went to check on it. And by the time they troubleshooted, it got that. So when since this technology is relatively new, you've got to train people on the production support side to be able to support that kind of investigation and resolution. So when you look at it from the business unit, that's what the operations guys and the tech guys are going to be looking at, and so they're going to be very skeptical. So anyway, I mean, so why doesn't it get to production level? All these things are being, that's why you're testing now, so you can see what's going to break.
Anybody who's not asked a question yet?
Questions now.
Last chance.
What happens if something goes wrong? What's the remedy, legal issues? Like, what happens if the settlement process some breaks and so-and-so gets blamed? This node on this bank.
I'm not sure I understand the question,
What
because you're,
happens
So you're talking about a permission network, right?
permission network?
And if a transaction, if something doesn't happen as according to terms?
Some failure happens or it's not being coded correctly or something, the business rules part of it. So I'm talking about if some kind of transaction failure happens, what's the remedy?
okay, so you're saying, but that exists today.
It exists today, but
So if
You
it,
can-
I mean, because in a way, I mean, I guess what you're asking is, will there be enough QA
Right.
so that it can go into production? And the answer is yes. And you're going to have existing normal processes for production support to do it. So if there is a new error type that the permission ledger would create, that's going to be QA. It has to be, right? I mean, there's always unintended consequences, and you may not be able to discover every little thing. So if that occurs, traditional legal process, or so if there's a failure in some, there's existing recourse that I think would go. Now, if it's a completely new issue, and Tim might have a better imagination about this than I, then I'm not exactly sure. So it gives me something to think about as we play around with testing.
Yeah, I mean, just to be clear, a permissioned system of a ledger that's shared by institutions doesn't mean nobody's watching the store, right? Right. There's likely going to be some centralized group that has to manage on behalf of the group of the participants. There's probably a legal structure, like a joint venture, that defines the liabilities for a bank or an institution whose node goes down. So this is one of the reasons why it takes a long time. So if you think it takes a long time for a single financial institution to do something, it takes a lot longer for a group of them to decide to do something. So these things have to play out. But just to maybe provide a positive spin on this, it's like, if there's money to be saved, and if there's time to be saved, they want that, right? There are a lot of pressures to extract as much of cost out of the way things are done today. And there's the reason why there's so much experimentation and testing going on right now. So they see those dollar signs going down, and it might be, hundreds of millions of dollars, it might be $10, I don't know. And I think that's what they're trying to figure out. But if they look at 100 different use cases and they see one of them has a savings of $100 million a year, I guarantee you they're gonna accelerate whatever they need to do to get onto that system.
So, one last question. Neha, you had a question?
Yeah, sure. I just take a step back, less technical, and going back to when you Tim were discussing sort of the overall landscape of sort of application of blockchain in finance, and you pointing out a lot of the application or use case scenario around supporting overnight rates. I was a humble understanding of what's going on with blockchain. I see a lot of people participating, or a lot of companies starting to address that same part of the market, and I just wonder, how, from your guys' perspective, since you see a lot of folks out there, what are people competing on, or how are they trying to define their value prop, if at all different? What are they competing against? What are they competing on? Maybe what's
So why are all these different companies saying OTC derivatives is a killer use case, and you have 8? I've probably seen 8 different companies say that. The question is what's the differentiation, or what is one of the reasons why they want to do that in the first place?
Well, maybe not so much why, since I feel like maybe you guys have already kind of touched on that, especially around transaction cost and it's I don't know, or maybe you could elaborate on that too. But.
So let's see. So you're talking about new entrants in the space that represent blockchain technologies?
Mm-hmm.
Yeah. So Tim had a very good slide earlier. You should refer to that, of the companies that are in the permissionless and permission space. I think that they're competing against 2 or 3 specific things and trying to solve problems. Number one, the big question a lot of banks are asking is well, what does this do that a database doesn't already do? Tim's answered that. I'd say to a large extent, the first line of people that are evaluating at banks have gotten over that. It's their managers that haven't. They're like, what's this thing really do? So that's the number one. Number two is, how does this application fit so that I am getting, these cost savings? And from a COO's perspective at a bank, they're looking at multiplier effects throughout the organization, because it's one thing to just go, okay, I can save cost on OTC clearing, right? That's a complicated matter because you've got listed products, or, well, in this case, over the counter. It depends on what derivative, because you've got different regulations in different jurisdictions. EMIR in Europe, Dodd-Frank in the United States, there's a separate one in Hong Kong that's emerging. So in that sense, it's sort of you have to look at it from that perspective and just go, okay, I'm not going to just solve OTC clearing. If you look at it from that perspective, it's that old adage, right? I'm defining, building a house by the nail. So that's the nail, and that's, in my opinion, wrong. You just that will only carry you so far, because in the end, The banks are going to want to know if they're going to create a new rail, it has to solve for a multitude of problems, not only at the trading level, but also at the settlement clearing, you know, at the compliance level, but also in terms of people and technology around it. So, you know, again, the value proposition for these entities that are approaching all of that has to encompass those components in some form or fashion. You know, and the third thing, you know,
So you would
everyone
say that,
likes
sorry,
to.
not to interrupt, but you would say that different companies are just missing different parts of the puzzle?
I
and so
think, you know,
no-
part of it is, and I don't mean this in a disparaging way, I think a lot of companies that are, you know, they don't have the financial trading experience. So if there's an additive value that they're gonna have to bring, is they're gonna have to hire, you know, folks like us and so on. And I see that happening. It's, you know, you've seen conversions out of, you know, some big names out of Wall Street. That's not enough. You need, like, you know, real like, you know, managers that understand the nuts and bolts about how all this stuff works. Because that'll help you understand the specificity around the workflow, you know, and because you can only imagine so much, and you can put together all these things, but if you don't have the right skill sets, you don't know what it's like to trade. You don't know what it's like to settle currencies. You know what I mean? And so I think that part of it is, you know, I think that's an easy kind of, you know, sort of, you know, next hit for a lot of these companies. And I think the final thing is everyone likes the shiny new object. I think this is all cool stuff. The promise of all this is amazing. You know, when you really step back and just go, look, I mean, the enthusiasm and the energy for effectively redefining value is enormous, and it's tapped everyone's imagination. And I think that's, you know, in the end, you know, take aside the daily vagaries of your job, you know, if you kind of think about it, that's a pretty neat thing to be part of. So I would add that as a small chemistry mix. Anyway, let you guys answer.
Let's give it up for the panelists. Peter Shao, and Raja Ramachandran, and Tim Swanson. Thanks, Robert. 1 hour.